Welcome to the Deep Dive. Our mission is simple. We take a stack of information articles, research your notes, and zero in on the most important nuggets, the surprising facts, the key insights. It's about getting you well-informed fast.
We're your guides, navigating the material you've shared to help you understand what really drives the core ideas.
Absolutely. And today, we're taking a deep dive into a detailed analysis focused on a major global industrial company, Linde-Praxair, ticker LIN. This analysis really, gets into its business quality and investment characteristics, looking at the business model, competitive advantages, management approach, financials, valuation, all of it.
Our goal is really to pull out the essence, what makes this business perform the way it does, and what are the critical takeaways for anyone trying to understand it deeply.
Okay, let's unpack this. What is Linde-Praxair at its core? What do they actually do?
Well, they produce and sell essential atmospheric and process gases. Think oxygen, nitrogen, argon, hydrogen, helium. These aren't like optional extras. They are fundamental inputs required by most modern industries.
Right.
And they also have a significant engineering division that designs and builds the complex plants needed to produce these gases on a large scale.
So they provide the critical ingredients and they build the kitchen, so to speak. How do they get these gases to their customers? What does that mean for their revenue streams?
They use a three-tiered distribution model, really depending on the customer size and needs. At the top, you've got on-site.
Okay.
For their largest industrial clients, think massive steel mills or chemical producers. Linde builds a gas production plant right there, connected directly via pipeline. And these operations are locked in with very long-term contracts, typically 10 to 15 years.
And those contracts have take-or-pay clauses, I thought.
They do, yes. And this is crucial. A take-or-pay clause guarantees Linde's minimum revenue over the contract term, pretty much regardless of whether the customer uses the full contracted capacity. It creates a stream of highly predictable, recurring revenue, very much like, a utility company's cash flow.
That sounds incredibly stable. What about the other two tiers, then? Next is merchant, or bulk. For mid-sized users, they deliver liquefied gases by specialized trucks to storage tanks at the customer site.
Okay.
And then there's packaged or cylinder gas for smaller users like welding shops, laboratories, or maybe hospitals. Gases are supplied in cylinders, and this segment also generates rental income from the cylinders themselves.
So a simple core product, basically taking air and separating it, but delivered through these distinct models. The analysis points out the enduring relevance of these gases. Why is their demand virtually assured for decades?
Because modern industry and society fundamentally rely on them. I mean, oxygen isn't just for hospitals, it's vital for steel making.
Right.
Nitrogen is critical for preserving packaged foods and manufacturing semiconductors. Hydrogen, well, it's key for refining today, but it's also central to the future low-carbon economy. These gases are just indispensable inputs linked to basic human needs and industrial processes that aren't going away.
And this seems reflected in their customer base. The analysis highlights that around 62% of sales come from defensive sectors. Right. That concentration in areas like healthcare, food and beverage, and electronics provides significant resilience. These sectors are just less sensitive to economic cycles than, say, heavy manufacturing, which helps smooth out Linde's growth and provides downside protection during recessions.
It's also important to note this isn't just some, legacy business. They are critical enablers for cutting-edge areas like advanced semiconductors and the entire clean energy movement with hydrogen and carbon capture.
Let's drill back into that on-site model for a second. You mentioned it has utility-like characteristics. What specifically about the finances of that model makes it feel so similar to a utility?
Well, building an on-site plant requires significant upfront capital. It's kind of like constructing a power station.
Okay.
However, unlike building speculatively, this capital outlay is largely de-risked by those long-term take-or-pay contracts we just discussed.
Right, the guarantees. They function much like power purchase agreements, guaranteeing revenue streams. But here's where it gets really interesting. These contracts typically include provisions to pass volatile energy costs, which are Linde's largest variable cost input, directly through to the customer.
So that insulates their profit margins from energy price swings.
Precisely. It transforms the sale of what might seem like a simple commodity into a high-margin, predictable, contracted service business with built-in inflation protection. For a capital-intensive industrial company, that kind of financial profile is quite unique and powerful.
That sounds like the bedrock of a serious competitive advantage, what the analysis calls an economic moat. How does Linde protect this business from competitors?
It has a formidable competitive fortress, you could say, built primarily on two pillars: high switching costs for customers and cost advantages derived from its vast scale and network density.
Let's tackle those switching costs first. Why would it be difficult or expensive for a major customer already using Linde on-site to switch to another supplier?
Well, gases like oxygen or hydrogen are absolutely mission critical to the operations. Reliability and safety are just non-negotiable. If you're running a steel mill or a refinery, disrupting your gas supply is, well, catastrophic.
Yeah, I can imagine.
Switching from an existing on-site plant, which is physically integrated into your operations, involves significant downtime, complex engineering, tearing down old equipment, integrating new. It's a massive operational risk.
And the cost of the gas itself isn't usually the biggest factor for the customer, right?
Exactly. For many of these large users, the cost of the industrial gas is a tiny fraction, maybe only 1% of their overall production costs.
Wow.
The potential savings from a slightly lower price are completely dwarfed by the enormous risk and cost of disrupting their entire operation by attempting to switch suppliers. This economic reality leads to extraordinary customer stickiness. The analysis notes around a 95% contract renewal rate on these long-term deals.
95% renewal. That's incredible.
It is. It's incredibly high and powerful proof of that stickiness.
Speaks volumes about how critical and reliable their service must be. Okay, let's look at the cost advantages, scale, and network density.
So, the industrial gas market is what's called a rational oligopoly. It's dominated globally by Linde, Air Liquide, and Air Products, they call them the Big Three, who hold about 75% of the market between them. Linde, being the largest, benefits from purchasing power on things like energy or equipment. But the most significant cost advantage comes from network density, and a strategy the analysis describes as piggybacking.
Piggybacking, how does that work exactly?
Okay, so when Linde builds a large on-site plant for an anchor customer, say, a huge chemical facility needing vast amounts of oxygen via pipeline, they often design that plant with excess capacity.
Okay.
They can liquefy this surplus gas and then sell it via truck to smaller merchant or packaged gas customers located nearby in that same geographic region. The key is that the marginal cost of producing that excess gas is extremely low because the fixed costs of running the plant are already covered by the anchor contract.
So they can serve those smaller customers in that area far more profitably than a competitor who doesn't have a local on-site plant.
Precisely. A competitor would have to truck in liquid gas from much further away, incurring significantly higher transportation costs. Linde uses its anchor plants not just for the main customer, but to efficiently flood the local region with low-cost supply. It makes it very difficult for competitors to serve those smaller customers profitably.
Wow.
They secure the long-term, high-margin anchor client and dominate the local market for others. It's a very, very clever and effective strategy.
That seems incredibly hard to replicate once it's established. Does the analysis suggest this moat is stable or perhaps changing?
It appears stable, and you could argue it's actually widening.
Right.
The 2018 merger with Praxair created the undisputed global leader, magnifying those advantages of scale and network density.
Right.
And looking forward, the energy transition offers a generational opportunity. As Linde invests billions in building new hydrogen and carbon capture infrastructure, they're essentially establishing new anchor customers and new network hubs for decades to come. This just further cements their leadership position and reinforces the moat.
It really sounds like a business built for the long haul. Moving beyond just the financials and structure, how do customers and employees experience Linde? Because for an industrial B2B company, customer love looks different, right? It's not like buying a coffee.
It absolutely does look different. For Linde's core large customers, customer love is all about reliability, safety, and consistent service. The analysis points to evidence suggesting strong satisfaction among these key clients. There was a 2017 survey that singled out Linde as the favorite of the industry, noting praise for quality, reliability, and service response ahead of price. And they're investing in initiatives, too, like digitally monitoring 2 million cylinders, aimed squarely at improving inventory management and on-time delivery, which are direct drivers of satisfaction for industrial clients.
And I imagine that 95% contract renewal rate we talked about is the ultimate proof point.
It's the strongest evidence you could possibly ask for. Companies just don't renew mission-critical, multi-decade contracts if they aren't receiving exceptional service and reliability.
Makes sense.
The analysis does acknowledge that public online reviews for smaller local packaged gas branches can sometimes be mixed, a local delivery issue or something. But it stresses these reviews don't really reflect the experience of the large strategic customers who drive the vast majority of the business and value reliability over minor price differences.
What about employees? The analysis mentions a slightly more nuanced picture there.
Officially, Linde promotes a very strong ethical and inclusive culture. They've been recognized as one of the world's most ethical companies, 5 years running. They're the only industrial gas company on the 2024 list, along with other most admired and DEI awards.
That sounds pretty good on paper.
It signals a significant top-down commitment to governance and employee well-being. However, anecdotal online employee reviews are mixed. You'll see praise for things like work-life balance and job security, but also comments citing, stringent policies or perceived favoritism.
That seems like a bit of a disconnect. How does the analysis explain that?
It links it back to the post-merger culture integration. Praxair, before the merger, was known for an intense focus on operational excellence and financial discipline. That's what drove their industry-leading margins and returns.
Right.
A key strategic goal of the merger was to instill this high-performance execution culture across the larger combined entity.
So that strong emphasis on driving efficiency and financial results might be perceived by some employees as stringent or demanding.
Exactly. If you look at CEO communications, they consistently highlight metrics like return on capital, which requires a relentless focus on productivity. This kind of culture, while incredibly effective at generating outstanding financial performance, can feel very demanding to some people working within it.
Okay.
The analysis frames this mixed feedback, not as a fundamental flaw, but maybe as a predictable byproduct of the very culture that creates its financial strength. And it notes that the Ethics Award suggests this culture is, well managed and rooted in sound governance, despite the pressure for performance.
That makes sense. The culture driving the results might also be the source of some internal friction. Let's transition to leadership and financials. The analysis paints a picture of strong management stewardship.
It certainly does. Linde is led by CEO Sanjeev Lamba. He's a long-tenured insider, previously served as COO. His leadership clearly continues the successful strategy established post-merger.
And how does that show up?
Well, looking at his public statements and how his compensation is structured, there's a strong alignment with long-term owners. He prioritizes metrics that really matter to shareholders, like return on capital, EPS growth, and operating cash flow. In his 2024 letter, he explicitly referred to management as responsible stewards of capital.
How is his compensation structured to ensure that alignment? Is it just salary?
No, far from it. He's required to hold company stock equal to 6 times his base salary, and he has to retain incentive shares until that holding threshold is met. So his personal financial interests are directly and substantially tied to the long-term performance of Linde's stock and the underlying value creation.
Okay, so management's incentives are clearly aligned with shareholder interests. How does that show up in how they allocate their significant cash flow? Where does the money go?
The analysis describes their capital allocation as exceptionally rational and disciplined. They have a clear hierarchy, it seems. First and foremost, they reinvest in the core business.
Makes sense.
Their capital expenditure guidance for 2025 is between $5.0 and $5.5 billion. That's funding their substantial $10-plus billion project backlog. And crucially, these projects aren't speculative bets. They are largely contractually secured with high-quality customers and are expected to generate double-digit returns on capital. It's very disciplined, low-risk, high-return reinvestments.
We're reinvesting first and into high-quality, pre-sold projects. What's next in the hierarchy?
M&A.
Second is M&A, yes.
Their approach there has been strategic and value accretive, meaning it adds value for shareholders over time. The 2018 Praxair merger was obviously transformational and clearly value-adding. Subsequent deals, like buying the remaining stake in Praxair, have been smart bolt-ons designed to expand their network density in attractive, growing regions.
And finally, returning cash to shareholders, I assume.
Absolutely. They return immense sums. In 2024 alone, they returned $7.1 billion through dividends and share buybacks. They have an impressive 32-year streak of consecutive dividend increases, which is a real testament to the stability and growth of their cash flow. Their payout ratio is around 36%, which leaves them ample room for reinvestment and funding that backlog. The analysis finds no evidence of value-destructive empire building, just a consistent focus on return on capital and capital stewardship.
It sounds like the qualitative aspects of the business, the moat, the management, the capital allocation translate into very strong financial performance. What does that look like in the numbers?
It's an exceptionally strong, consistent performer. The analysis calls it an earnings machine with a fortress balance sheet. Net income has shown steady growth, and their operating margins have actually expanded, reaching 29.5% in 2024 and climbing above 30% in Q1 2025. This is pretty remarkable.
Very strong margins.
And their EPS has compounded at 12% annually from 1993 to 2024, significantly outpacing peers and the broader market.
That's impressive growth for a large industrial company over such a long period. Let's look at some key profitability and efficiency metrics. Return on invested capital, ROIC, is often seen as the gold standard here. How do they stack up?
And Linde shines there. They reported a return on capital, ROC, which is a slightly different but comparable metric they use, of 25.9% in 2024. The analysis also estimates a normalized ROIC around 12.46%. For a capital-intensive industrial business, these figures are exceptionally high and comfortably exceed their cost of capital.
So that's the proof of the moat, really.
It's the quantitative proof, exactly. It shows that durable moat and value-accretive capital allocation, we discussed it, demonstrates they are efficiently using capital to generate high returns and compound intrinsic value over time.
How about converting those earnings into actual cash, free cash flow conversion?
Yeah.
Is the cash real?
Very real. They generated $9.4 billion in operating cash flow in 2024, leading to $4.9 billion in free cash flow after capital expenditures. That's about a 74% conversion rate of net income to free cash flow.
Which sounds good, but not 100%.
Right. And while it's not 100%, the reason it's lower isn't a concern. It's directly due to the significant capital expenditures they are making right now to fund that massive $10+ billion project backlog.
Ah, the reinvestment.
Exactly. The underlying earnings are very real and backed by immense cash flow, which, as we saw, enables those large shareholder returns even while they invest heavily.
And the balance sheet strength. You mentioned Fortress.
Yeah, Fortress seems appropriate. Their adjusted net debt to EBITDA was a very conservative 1.4x in Q1 2025. This indicates low debt relative to their earnings power and provides a substantial margin of safety and considerable financial flexibility for whatever comes next.
So qualitatively and quantitatively, this analysis paints a picture of a truly wonderful company. But as investors know, buying a wonderful company at the wrong price can still lead to poor results. The analysis then turns to the crucial question of valuation. Is this wonderful business available at a fair price?
That's the million-dollar question, isn't it? Based on the analysis as of mid-2025, the valuation is demanding on an absolute basis. Looking at traditional metrics, the trailing price to earnings, or PE, ratio is around 34.8x, and the forward PE is about 28.7x.
Okay, so high multiples.
Yeah, and price to free cash flow, PFCF, is even higher, around 45.8x on a trailing basis.
How does that compare to where the stock has traded historically, particularly since the Praxair merger? Has it always been this expensive?
Looking at the post-merger period from 2020 to 2024, the current PE ratio, around 34x, is actually below its 5-year average, which was closer to 40.9x.
Oh, interesting.
But the PFCF, around 45.8x, is elevated. But again, that's largely a reflection of the current heavy investment cycle we discussed. The denominator of the free cash flow number is temporarily lower because they're plowing billions into those high-return projects.
So it's expensive, but perhaps not historically uniquely expensive on all metrics, especially PE. What's the overall conclusion on valuation in the analysis?
Fair.
Too high.
The conclusion is that the valuation is demanding, yes, no question. But it might be argued as fair for a multi-decade investor. It's certainly not a bargain bin stock, and it offers very little near-term margin of safety against potential stumbles or bad news.
Right.
But the analysis stresses you're paying for a best-in-class global oligopolist with utility-like stability, industry-leading profitability, those 30% margins, 25% plus ROC, a fortress balance sheet, and management laser-focused on creating shareholder value. Such high-quality assets are just rarely found trading at steep discounts.
So the price is the price.
The analysis refers to the current valuation as essentially the price of admission for a business of this caliber. It suggests that for a truly long-term owner, paying a fair price for an exceptional business has historically been a proven path to wealth creation.
Let's talk about future growth then. What is the single most important driver identified in the analysis for Linde going forward?
It's overwhelmingly the global clean energy transition, specifically centered around the hydrogen economy. While Linde will continue to grow with its resilient end markets and general industrial activity, decarbonization is seen as a massive structural supercycle that will create demand for their products and expertise over decades.
So not just incremental growth, but a major tailwind.
A major tailwind. The analysis positions Linde not as some speculative green tech company, but as the dominant, established picks and shovels provider, enabling this transition. They make the essential stuff needed for it to happen.
And is there tangible evidence of this opportunity now, or is it still mostly theoretical?
Oh, it's very tangible. Linde has deep, long-standing expertise across the entire hydrogen value chain from production, including green hydrogen technologies like electrolysis, right through to processing, distribution, and storage. They are a technology leader involved in building things like the world's largest PEM electrolyzer.
What's PEM again?
Proton exchange membrane technology. It's crucial for producing high-purity green hydrogen efficiently. And this leadership is directly translating into that $10+ billion project backlog we mentioned, which is heavily weighted towards clean energy projects. These are contracted high-return projects expected to drive earnings growth for many years to come.
That structural tailwind sounds powerful, but no business is risk-free. What are the primary long-term risks identified that could potentially damage Linde's earnings or even its moat?
The analysis points to a few key possibilities for, permanent impairment. One is a fundamental structural shift in energy costs. If cheap, localized energy generation, maybe from distributed renewables or fusion or something unexpected, becomes so widespread and affordable that it significantly alters the economics of producing gases on site or changes the cost structure of transportation, it could potentially erode that network density moat that relies on centralized production and efficient distribution hubs.
So disrupting the core cost structure of the entire industry. What else?
Technological obsolescence is another one. The moat is built partly on the high capital cost and specialized expertise required for large-scale air separation and gas production. If a truly disruptive new technology were to emerge,
like what?
Maybe something that allowed for cheap, efficient, small-scale gas production directly at the customer site, potentially bypassing Linde's large plants and complex distribution network altogether. That could fundamentally disrupt their business model and devalue their existing assets and network advantages.
Okay, a tech disruption. Any others?
And finally, geopolitical fragmentation. As a deeply global company with integrated operations and supply chains, deglobalization trends, escalating trade wars, or increasing capital controls and asset risks in certain countries, that could increase operational complexity, potentially strand assets, and reduce the efficiencies and economies of scale they gain from their global footprint. This could lead to lower returns over time.
Makes sense for a global player. Let's put this all together and think about how the market views Linde versus the deeper dive we've done. What's the general market consensus, and how might the analysis we've reviewed offer a different perspective, maybe an edge?
Well, the market consensus is broadly positive, as you might expect for a company of this quality. Analysts largely rate it buy or strong buy. They acknowledge its resilience, its moat, its growth prospects. The main area of debate, and often why analysts land on fully valued, is precisely that premium valuation we discussed.
Right, the price tag.
Exactly. Price targets typically suggest only modest near-term upside, maybe in the range of 4-9%.
So the market recognizes it's a great company, but sees the stock as expensive right now, limited upside in the next year or so.
That's the common view, yes. The analysis doesn't really disagree on the quality aspect, but it suggests the market might be underestimating two key things: the duration and the compounding power of that energy transition growth runway we talked about. The market might be valuing Linde primarily as a high-quality industrial company with a sort of cyclical clean energy boost, rather than a business position to benefit from a structural supercycle that could last for 2 decades or even more.
And Wall Street's typical focus is often on the next 12 months, maybe 24, which isn't a great lens for valuing a potential 20, 30-year driver.
Exactly. Standard analyst models can struggle to fully capture the value of contractually secured cash flows stretching out over many years from a multi-billion-dollar project backlog like Linde's. And crucially, the analysis suggests the market may also miss the second-order effect. Building this new clean energy infrastructure isn't just generating returns on capital today, it's actively widening Linde's moat.
How is it widening the moat?
By solidifying their network density and pricing power in new critical areas like hydrogen and carbon capture for a generation. So the market sees an expensive stock with limited near-term price upside. The longer-term view presented in the analysis sees a potentially fairly priced claim on a business that could compound intrinsic value at double-digit rates for perhaps 2 decades or more. The analytical edge here is simply adopting that much longer time horizon.
Let's quickly summarize the compelling bull case for Linde based on everything we've covered. What are the key pillars?
Okay, quickly. You've got an indispensable business operating in a rational oligopoly. It's protected by powerful, durable moats, high switching costs, and network density, which you see reflected in industry-leading profitability and returns on capital.
Right.
Management is exceptional, clearly owner-aligned in their capital allocation strategy, prioritizing high-return reinvestment alongside robust returns to shareholders, including that amazing 32-year dividend increase streak.
And the growth.
And fundamentally, there's a clear multi-decade secular growth runway driven by the energy transition, particularly the hydrogen economy. And this isn't just hope. It's backed by a tangible, contracted $10+ billion project backlog.
Okay, that's the bull case. What's the red team challenge? The counter thesis, the scenario where buying Linde today could turn out to be a big mistake.
The primary risk identified centers squarely on valuation risk tied to that growth story not unfolding as anticipated. You are paying a premium today, explicitly pricing in that future hydrogen growth. The challenge is to imagine what the analysis calls a hydrogen winter.
A hydrogen winter. What would that look like specifically? How could it happen?
It could involve several things. Maybe government subsidies for green hydrogen get cut due to fiscal constraints or changing political winds, or perhaps other competing technologies like advanced battery storage or direct electrification for industrial processes become significantly more cost-effective than predicted, making green hydrogen uneconomical for large-scale use in many applications. In that scenario, Linde's massive capital investments into new hydrogen infrastructure could become low return or even stranded assets. The project backlog would evaporate, and growth would revert back to maybe low single digits, tied only to general industrial production.
And what about the moat itself? Could that be challenged in this bear case?
Yes, the counter-thesis also includes the risk of disruption to the moat. Imagine a scenario where a customer, maybe a big one, partners with a startup to develop a truly revolutionary, cheap, small-scale on-site production technology.
Bypassing Linde entirely.
Exactly. This tech could bypass Linde's centralized network and effectively shatter those switching costs we talked about, allowing customers to produce gases much more cheaply themselves.
If either of those winter scenarios played out the hydrogen disappointment or the moat disruption, what's the consequence for the stock price for someone buying today at these levels?
Linde would likely be significantly re-rated by the market. It wouldn't be seen as a high-quality compounder with a powerful secular growth driver anymore, but rather as a great business, but with no significant growth.
Okay.
Its premium, 34x PE multiple, could compress dramatically, potentially falling to a more typical mature industrial multiple, perhaps in the 15-18x range. For an investor buying today, this multiple compression alone could result in a loss of around 50%, even if the underlying earnings remained completely flat.
Ouch.
It could become a decade or more of dead money, or even permanent impairment, specifically because you paid a premium price for a growth story that ultimately didn't materialize. That, according to the analysis, is the primary risk you face when buying a wonderful company at a demanding price.
So we've really dug into Linde-Praxair, seeing a picture emerge of a truly exceptional business, indispensable products protected by powerful, durable moats, run by disciplined, owner-aligned management, and positioned for what looks like a clear multi-decade growth opportunity in the energy transition.
The core tension highlighted throughout this analysis is absolutely the price you pay today for all that quality and future potential. As we discussed, the valuation is demanding, no doubt, but perhaps fair if you adopt a very long-term perspective, given the nature of such a high-quality compounding asset.
But it's critical to remember those real long-term risks, particularly if that key growth story, the hydrogen economy, doesn't unfold as anticipated, or if the foundational moats are somehow challenged by disruptive technology or major shifts in energy economics down the line.
Yeah, absolutely. Which brings us to a provocative thought for you to consider, building on everything we've just explored. Given Linde's indispensable role in a potential multi-decade structural shift like the global energy transition, does the current valuation seem high relative to the next year's potential earnings? Or does it perhaps look more like a reasonable price of admission for the value that could potentially compound over the next 2 decades? Something to think about.